Hi, I'm Mike Gassewitz, CEO of IAIC, and welcome to another episode of In Focus. Today, we're going to have a quarterly update on our consumer segment. And joining us today is Pat Tryon, one of our portfolio managers responsible for the consumer segment. Welcome, Pat.
Morning, Mike. How are you?
Oh, I'm good. Great to have you on the show. Just a reminder to the listeners, the subsectors within consumer are healthcare, staples, and discretionary. So maybe, Pat, we can have a look at the last quarter. What did we see from the results perspective in terms of how the companies are doing or did, and then how the market reacted to that?
Sure, Mike. Let's start off with the consumer discretionary. So for the last quarter, Q2, consumer discretionary was up 14.8%. Year to date, they're up about over 30%. And over the last 12 months, they're up 24.7%. That's the third best performing sector in the S&P 500, behind only technology and communications. I would warn you, however, that the number is slightly misleading, since the two largest names in consumer discretionary are Amazon and Tesla. Amazon is almost 23% of the index, and Tesla is almost 21%, a combined 43% of the index. Amazon's up nearly 50% at the end of Q2. Tesla was up 155. Their combined weighted performance was 43%, and yet the XLY was only up 30. In other words, the rest of the index was down nearly 13%. So two names really driving it forward, but broadly speaking, in the consumer discretionary, they've been struggling.
Okay.
That said, earnings for consumer discretionary are expected to be higher this year, so that should improve.
Yeah.
In terms of healthcare and consumer staples, healthcare for the quarter was up 1.8. For the 12 months, it's up 5.2. And consumer staples was actually down 0.5%, and for 12 months, only up 5%. They've actually been two of the worst performing sectors year to date in the S&P 500. That's kind of puzzling because they are typically defensive groups, and the economy has been slowing down. But if we're looking at performance, the market is favoring growth. That's why you see tech doing so well.
So that's a great summary in terms of what we saw in the markets, Pat. In terms of the companies we have on our core pick list, how did they do from a results perspective, their own financial results perspective?
It's a mixed bag, and for a variety of reasons. We could look at a company like Walmart, who's one of the biggest retailers in the world after Amazon, and they did quite well. In fact, they raised their guidance for the year. What they're doing really well is they're moving their turnover of assets is driving sales higher. They're also increasing the amount of sales they get electronically. Their margins continue to fall, but because they're pumping more volume through, they're actually doing better. Canadian Tire, on the other hand, is struggling with margins. People still go to buy their everyday stuff there, but things like patio furniture, bicycles, umbrellas, really highly discretionary items have really kind of fallen off the list. Consumers are being much more discerning in terms of what they're buying and why.
Right. And you could even say that's, to a certain extent, I mean, this is the whole, monetary policy, right? The bank is trying to slow some of this down, which, again, can be, well, anyway, trying to slow down the economy. And it's the idea, raise interest rates, bite into the consumer's discretionary decisions, right?
Exactly. I was going to reference that also, in the sense that interest rates have risen significantly. It's impacted people's incomes. The cost of servicing debt is as high as it's ever been for the individual since 1989. So it's going back nearly 40 years to reach back for a number that high, that's significant to consumer spending.
Right. So, and then if we look at healthcare and staples, generally, I mean, the concept is they're supposed to be a little more stable, even through challenging times when the central bank is trying to cool the economy a bit. Is that what we saw from a results perspective?
The consumer staples have done a good job in terms of holding in their earnings. It's come at the cost of volume. They're They've raised prices. They've been very successful at raising those prices and making them stick, but people are buying less. Nonetheless, their earnings are pretty good in that regard. The reason the performance is lagged behind, these companies are trading at very rich valuations, up in the mid-20s in terms of their price earnings ratio. They're known as the expensive defensives. Healthcare, slightly different reason. There's always the issue of political risk. And you might have seen it most recently. Yesterday, actually, there's a bunch of drugs that the U.S. government put on a list that they're now going to negotiate for in terms of buying for Medicare.
Right.
I think that they're starting with 10, but they're going to expand that list, and that's going to crimp pharmaceutical companies' profits, healthcare company profits. So they're trading at very cheap valuations, but no one wants to touch them because the future is very difficult to see.
Okay. So let's talk about looking forward then. What are there any areas as you look towards the next few quarters that you want to chat about?
Sure. I'd like to talk about housing, primarily in the U.S., but it applies to Canada as well. So in the U.S., housing comprises roughly about 16 to 17% of U.S. GDP, or gross domestic product. And there is and has been a long-term shortfall between supply and demand for houses in the U.S. This shortfall goes back at least 20 years. And if you look at household formations, in other words, the rate at which households are being put together, people getting married, starting families, and houses actually being built, there's about a 4.3 million gap, shortfall of necessary housing.
Right.
In addition, and this references interest rates, the median housing payment for an existing home is more than double what it was just a few years ago. The median American household would need to spend over 40% of their income to afford a medium price home today. And that's up from 28% in 2020. So as a consequence, we've seen house sales falling and the number of homes for sale falling as well. In May, it was the lowest level on record going back to 2012. Compounding this problem is that 62% of U.S. mortgage holders have a rate below 4%, and 92% have a rate below 6%. So with current mortgage rates at close to 7%, many existing homeowners are staying put. No one is trading a mortgage between 3 and 4% for 30 years for a 7% mortgage for over 30 years. So as I said, inventories for sales have fallen, prices have fallen. The only activity in the house where this shortfall is going to be addressed is in new housing.
Right.
And Home Depot is uniquely poised for that because they're going to sell a lot of the lumber that's going to be provided for new housing. In addition, people aren't spending as much on housing, but they are doing, fix-it-up type jobs. And this is a primary source of revenue for Home Depot as well, both for guys who do it yourself as well as people hiring contractors to come in. So we find Home Depot is kind of an attractive or an interesting company here, because at some point, probably within the next year, you're going to see interest rates roll down. And this is going to be a very good opportunity for Home Depot. Stock is down from over $400 at its peak back in 21, traded as low as 260. If we can, I think it's trading around 330, 325, 330 now. And if we can get it for that price, or maybe a little bit lower, we find that very interesting for the longer haul.
Makes a lot of sense. And it's interesting, we've been talking a lot about interest rates as everyone has been. And the fact that the yield curve is inverted, to your point, that, the market is basically predicting that rates will come down. I mean, that's one of the challenges of fighting inflation with interest, as the Fed or the Bank of Canada increases rates, you could end up into a stagflation like period that we had in the late 70s and into the 80s. The good news is, at least at this point, the market feels that's not going to happen. To your point, that if rates are predicted to start to come back down, and that could hopefully will, that's a good signal to the builders out there to start putting more product into the market and not worry about it sitting on the market waiting for buyers. So seems like a good analysis. Yeah, for sure.
I was just going to give you one quick stat. just apropos of that, in anticipation of that, of rates falling, housing starts rather, jumped 21% in May, which was the biggest month-over-month increase since 2016. And another sign of green shoots is we now have had the third consecutive month of real wage growth out there. So this is kind of, as I said, it's early signs of green shoots within this industry. And so we seem to be optimistic to go along with the structural deficit that exists in housing. And we see the same thing with the structural deficit in Canada as well.
Right. So those stats were US stats, but to your point, we're seeing similar type indicators in the Canadian market.
Oh, yeah. And if you live in Ontario, you know all about the green belt and what that's all about.
Oh, that's another episode, on its own. Okay, Pat, thanks for this.
Thank you very much, Mike.
As always, folks, if you have any questions, feel free to chat with your financial advisor at your accounting firm, talk to your IAIC portfolio manager, or don't hesitate to reach out to myself. Take care.